markets are attempting a kind of a rebound, not very successfully, but at least some trials are being made. But you can say that the ferocity with which we were falling yesterday, that is not being seen today. What to read of this? And how should you be formulating your portfolio strategy? Viral Berawala is joining us now to talk more about that. Viral, before I talk about Indian market, a good amount of time has passed. People are drawing parallels of this to 2008 crisis, rightfully or not. Do you think we are in that kind of a dire situation? SVB was a very niche kind of a bank catering to, some are questioning whether it was a bank or not, but it was catering to requirements of one of the ecosystems, not the entire economy. But then regular banks also are falling in US, Europe on fears that there could be a kind of a liquidity crisis overall. Is it market stretching the argument too far?
Sure, Ajay. Good afternoon. So it's unlikely that this SVB event creates a systemic issue. While the memory from the GFC is still raw, this is not exactly the same. This is not a credit failure, but a treasury failure. By treasury failure, I mean treasury of the banks, right? So a bank essentially sort of borrows short and lends long. What happened is that because this has been one of the fastest or maybe the fastest rate hikes in US, this caused a lot of those treasuries to fail, and that has created a mark-to-market issue. Liquidity has been questioned, but it's not the solvency. But with US Treasury stepping in, this seems to have averted for now, and this doesn't appear to be a contagion. SVB was very important in the startup ecosystem. 50% plus of recently funded companies or startup funded companies were SVB clients. It also used to provide a lot of those bridge funding, which a normal bank doesn't do. So that gets impacted for a bit, but it's only for a bit, and the depositors are safe. So this really is not anyway close to 2008.
Right. Viral, so how's the world looking right now? Are we in a risk-off? Do you think this will turn to risk-on if today's reading on US CPI comes in lower, and if US Fed actually goes ahead and calms down the market, assuring them of liquidity and perhaps slower rate hikes, or even a cut, actually, some are saying? Will that change the momentum globally?
Sure. So right now we're definitely in a risk-off situation. Globally, if you see, VIX has gone up by 20 to 30% from whatever they were trading at over the last few days. So we are clearly in a risk-off situation. Secondly, market seems to have priced in a slower rate hike by the Fed. So a week back, almost 40% of the market was pricing in a 50 bips rate hike in March. That suddenly almost 40% people now feel there won't be a rate hike. So the rate hikes cycle might be slower, but in our view, it will probably get elongated. The issue is inflation, right? And inflation doesn't go away because of this banking crisis, so to speak. So inflation will stay, but because Fed might not want to sort of shock the system too much, instead of having maybe a 50 and a 25 bips rate hike, you might have 25 over 3 sort of meetings, or maybe even have a break in or a pause in between. So the whole issue gets elongated. I think the Fed statement today should be calming on the markets, and probably for this sort of round, we are close to the bottom in the markets.
What about Indian markets? Are valuations now in a good constructive zone? If one were to build a portfolio or do additional purchases in the market, we will come to what to buy in a bit. Can we expect good positive returns on a 1 to 2 year basis?
Sure. So for Indian markets, we'll take the banks first, because give or take banks plus financial is 35 to 40% of the Nifty. So in India, similar situation like the US almost cannot happen. The LCR, the liquidity coverage ratio, is very high, and break-even yields in India are at 7.5%. We are there. So, and even the mark-to-market, even at today's rates, might be 5% of a year's PPT for PSU banks, private much lower. So US type of situation is unlikely in India. Valuations, the second point that you alluded to in India, are still higher than averages. We are now trading at less than 20 times a trailing PE. But my issue is with the growth estimates. The consensus still is expecting almost a 13 to 15% type EPS growth for 24 and 25, which is very, very likely to be downgraded. And when that happens, sort of India's premium to Asia ex Japan, which is at 70%, will start looking even starker. So valuations in India still look a little bit higher. And the third part of your question, where do we see markets in 12 to 24 months? Over the next few months, it will, in our view, will be a great time to accumulate stocks. You sort of need to be disciplined over the next few months. The gyrations of the shock will be there for a few months. And that is the point of time you keep on accumulating these shocks. Whenever we have seen markets trade at this level, 12-month return might have been negative, but 24-month returns have always been positive and in the range of 12 to 20% CAGR.
Okay, so that explains how you should be positioned in the market. What are your thoughts? Where are you hunting for value? What themes or subjects are you researching? Within then the stocks will come up on your screener. Is it capital goods, NBFCs, insurance, chemicals? What exactly are you reading?
So exactly. So as I said, financials is a place we are still very keenly looking at. Financials to us is still the best way to play out the domestic growth story, which is likely to be strong over a period. So financials clearly stays on the radar. Within financials, we like the larger private sector banks and a few PSU banks. That's where we are. We are really not going down the list in terms of shopping for smaller banks. That would happen a little later. And if you, other than sectors, I think a lot of small caps offer a lot of value. Even if you look at BSE 500 and especially the smaller 250 companies, on an average, they are down 25% plus from where they were in January 22. So there is a big sort of place where there is value, which is small caps. You might see 10-15% down lower in that. But if you can sort of stomach that volatility, small caps are likely to give you disproportionate returns over a medium term.
Okay. And what are your thoughts on this point which you just made, that is there a risk of scaling back of earning estimates? Have that been adjusted in the new reality? Do you think there is scope that the estimates of the ecosystem need to be rolled back for a more realistic valuation assessment?
That looks a very likely outcome. And if we go sector by sector, right, a few sectors where I think which contribute a lot to Nifty valuations, where estimates might get rolled back. First one is IT services. IT services, again, most estimates for FY24 and 25 for EPS growth are in double digits. If rupee doesn't depreciate, which to us seems unlikely, then you will see those estimates come down, because the revenue growth will start falling back to single digits, definitely for FY24 and very likely for FY25 too. So IT will sort of underperform there. Financials, you might have a couple of quarters where you take some bit of treasury losses if rates spike up in India too. So financials also is one place where you might see a lower sort of earnings what is being projected. And finally, the third bigger contributor, which is FMCG. So in FMCG also, people are again building margins to go back up to where they were in FY20 or 21 or 22, which looks difficult. And we are already seeing consumption slow down in India. Some of the lead indicators in India also are not as good. So FMCG will probably also need to be revised downward. We've covered 60% of Nifty where we think the earning estimates get downgraded.
Okay, before I let you go, one last word then. Looking at the screen, looking at the data, analyzing the environment, looking at numbers, do you see we are somewhere near a bottoming phase of the market, or it will be too early to draw that assessment?
So, if there are no second order effects of what's happened with SVB and the other bank failure, right? You've got the second and third largest failure of US banks in the last 4 or 5 days. So if there are no second order effects of that, probably for India, we are close to the bottom. India has underperformed materially since December. We are already down 10%, whereas despite the fall, Nasdaq is still up 8%, S&P 500 up 2-3% in this period. So there is a lot of underperformance, that is the near-term underperformance in India. And given that we'll still remain the best or fastest growing large economy, at least for the foreseeable future, FIS flow should somehow or at some point of time start reversing. And that's the point we reach bottom in India, so which should be reasonably soon.
Right. All right, Viral, we'll let you go on that one. Thanks so much for joining us on the show today.